#ETF portfolio, mistake narration script. Right now, 92% of Americans are making the same ETF mistake that's costing them $400,000+ in retirement. You probably don't even know you're doing it. And here's the scary part: the longer you wait, the worse it gets. In the next 8 minutes, I'm showing you exactly what you're doing wrong and how to fix your portfolio before it's too late. I remember sitting in my apartment 3 years ago, thinking I was crushing it with my investments. I had a bunch of ETFs, those baskets of stocks bundled together that everyone says are the safest way to invest. SPY, QQQ, a little bit of VTI, looked good on my brokerage app. But I was completely missing something obvious. Something that was literally eating away at my future wealth without me even realizing it. Then I did the math, and I nearly threw my laptop across the room. See, here's what happened. I was using ETFs, which is actually a smart move. They're way better than picking individual stocks. I'm not some crazy gambler trying to bet on the next meme stock. But I was doing something that most people do, and it's absolutely destroying their long-term returns. My financial advisor friend finally called me out on it. He basically said, "Dude, you're leaving 6 figures on the table." And that's when I realized what 92% of people are doing wrong. Let me break this down for you, because it's not complicated once you understand it. And I'm being serious. This might be the most important 8 minutes you spend on finances this year. The first mistake people make is thinking all ETFs are the same. They're not. This is huge. Most people just see that an ETF tracks the market and think, yeah, that's good enough. But here's where it gets dangerous. There's a hidden cost in almost every ETF that most people never even look at. It's called the expense ratio. This is basically the annual fee that the ETF charges you just to own it. And even though it sounds small, we're talking 0.03% to 1% per year. This tiny percentage compounds into hundreds of thousands of dollars over 30 years. Let me give you a real example. Say you have $50,000 in an ETF with a 0.5% expense ratio. That sounds harmless, right? But over 30 years, assuming a 10% average annual return, that 0.5% fee costs you about $180,000 in lost gains. That's money that could have been compounding for you, but instead it's going to the fund company. And most people don't even know they're paying it because it's automatically deducted. Now here's the villain in this story. Fund companies don't want you to know about this. They actively make it hard to compare expense ratios. They bury it in documentation that nobody reads. They use fancy names for their funds to make them sound exclusive and fancy when they're really just tracking the same market as a fund that costs 90% less. It's infuriating. The second mistake, and this is what finally woke me up, is that people aren't rebalancing their portfolios. I know that word sounds boring and complicated, but stick with me because this is actually the secret sauce that separates people who build real wealth from people who just let their money sit there. Here's what's happening in most people's portfolios right now. They set up their ETFs maybe 5 years ago and they just left them alone. They never touch them again. Sounds responsible, right? Wrong, because the market doesn't move evenly. Some sectors go up way more than others. So if you started with 70% stocks and 30% bonds, which is a normal balanced portfolio, after a few years with the bull market we've had, you might be at 85% stocks and 15% bonds. You've accidentally made your portfolio way riskier without even trying. And here's what happens next. Either the market crashes and you lose way more money than you were comfortable with, or you get to retirement and you realize you're actually overexposed and you should have adjusted years ago. This is literally leaving free money on the table because rebalancing forces you to do something really simple but powerful: sell high and buy low. You sell the stuff that's gotten expensive and you buy the stuff that's gotten cheap. It's the opposite of what our emotions tell us to do, which is exactly why it works. The third mistake is that people are investing in the wrong type of ETF for their specific situation. This is where it gets really personal because your best portfolio isn't the same as your neighbor's portfolio. Most people just copy what they see on Reddit or what some finance influencer recommends. And sure, the advice isn't always bad, but they're not accounting for their situation. Your age matters, your time horizon matters, your risk tolerance matters, How much money you already have matters. I was in my late 20s when I made this realization, and I was throwing everything into aggressive growth funds. That's actually probably not terrible for someone that age, but I wasn't considering the fact that I had basically no emergency fund. So when my car broke down, I had to take money out of investments. And guess what? The market had just dropped 15%, so I locked in massive losses because I wasn't prepared. Then there's the tax situation that nobody talks about. If you're investing in a regular taxable brokerage account versus a 401(k) or IRA, some ETFs are way more tax efficient than others. This matters so much. Some ETFs throw off capital gains distributions every year that you have to pay taxes on, even if you didn't sell anything. Other ETFs are structured in a way that minimizes this. Over 30 years, picking the tax-efficient version could literally mean an extra $50,000 to $100,000 in your pocket, just because you understood this one thing. The fourth mistake, and this one blew my mind when I finally understood it, is that people aren't using ETFs strategically within their overall financial plan. They're just treating them like a set-it-and-forget-it investment, which is only half the story. The real power of ETFs comes when you understand how to layer them together strategically. You want international exposure, but maybe not as much as domestic. You want some bonds, but maybe you want them in a specific type of bond fund. You want some real estate exposure through real estate ETFs. You want some dividend-focused ETFs maybe. When you combine these things intentionally, you create something way more powerful than just owning a simple 2- or 3-fund portfolio. This is where most people get stuck. They don't know which ETFs to actually combine, so they either do nothing or they overthink it and buy way too many things. The sweet spot is usually somewhere between 5 and 12 different ETFs, depending on how much money you have. Any less and you're not diversified enough. Any more and you're not giving them each enough room to make a real impact on your portfolio. So here's what I did to fix my portfolio, and here's what you should do too. First, audit everything you currently own. Write down every ETF you have and look up its expense ratio. If you have anything over 0.2%, you might want to think about replacing it with something cheaper that does the same job. This is just free money you're giving away. Second, calculate what your actual allocation is right now, not what you think it is. Actually do the math. Add up all your money in stocks, all your money in bonds, all your money in real estate, all your money in international stuff. Then compare it to what you wanted your allocation to be. If they're off by more than 5%, it's time to rebalance. Third, honestly assess your situation. How old are you? When do you need this money? What's your actual risk tolerance? Like real honest answer, not what you think it should be. Then match your ETF selection to that. If you're young and aggressive, yes, throw 90% into stock ETFs. If you're 10 years from retirement, maybe dial it back to 60% stocks and 40% bonds or other stable investments. Fourth, make sure you're putting your ETFs in the right type of account. Tax-advantaged accounts first, max out your 401(k), max out your IRA, use that 529 plan if you've got kids. Then use taxable accounts for anything extra, but choose tax-efficient ETFs for those accounts. And here's the thing that changed everything for me: set a calendar reminder to rebalance once a year. Just once a year, spend 30 minutes on this. Check your allocations. Make any necessary trades to get back to your target allocation. That's it. This one habit, done consistently for 30 years, is going to make you hundreds of thousands of dollars wealthier than people who just buy and hold without ever adjusting. The crazy part is that this isn't complicated. You don't need to be a genius. You don't need to watch stock tips every day. You don't need to pay someone 1% of your assets in fees to manage this. This is something you can handle yourself in like an hour per year. 3 years after I figured this stuff out, I actually calculated my difference. By switching to lower fee ETFs, by rebalancing strategically, and by putting everything in the right accounts, I estimated I'm going to have about $380,000 more in retirement than I would have had if I just kept doing what I was doing. That's not because I'm a genius. That's because I fixed 4 specific mistakes that 92% of people don't even know they're making. Don't be part of that 92%. Spend the next week going through your portfolio, look at what you own, check those expense ratios, calculate your actual allocation, Make a plan, and then execute it. Your future self is going to be so grateful.